I once made the gravest mistake a trader can make. I tried to time the market without first identifying the phase it was in. In my early years, I recall a campaign in a certain railroad stock that had drifted lower for months. The tape showed dull volume, narrow spreads, and a kind of lifeless drift that most traders interpreted as the final exhaustion of demand. I, too, fell for that illusion. Believing the markdown was nearly over, I attempted to catch the bottom, convinced I had spotted a turning point. But what I failed to recognize at the time was painfully simple in hindsight. The stock wasn't bottoming, it was still in phase C of distribution, testing supply one last time before the true markdown began. The composite operator was unloading quietly, while the public mistook every small rally for a change of character. And so, instead of being early at the beginning of a new trend, I was early into a trap designed precisely for impatient traders. Price broke down violently 2 weeks later, slicing through the previous support like it never existed. My perfect timing was nothing more than a poorly disguised guess, because I didn't know which historical phase the market was in. Only then did I learn the truth that defines every successful operation. Perfect timing isn't about predicting. It's about recognizing which phase the market is repeating. When accumulation begins, the footprints are always the same. When distribution matures, the behavior is unmistakable. When markup or markdown emerges, every wave echoes the same law of supply and demand. The market doesn't need to be predicted. It simply needs to be read. And from that failure, I realized, if you cannot identify the phase, you have no business trying to time the turn. If you can identify the phase, the turn reveals itself. You might think the greatest challenge in trading is timing. You watch the candles, you scan the indicators, you listen for the whispers of news. You position yourself for a breakout, you brace for a reversal, you anticipate a trend. Many declare themselves masters of timing, but make no mistake, what they truly master is confidence. And confidence by itself is not a strategy, because without understanding which structural phase the market is in, accumulation, markup, distribution or markdown, what you call timing, is nothing more than a well-dressed guess. Imagine you walk into a theater midway through a play. If you don't know whether it's the first act or final scene, you might applaud at the wrong moment, stand up too early, or leave before the curtain falls. The drama would feel chaotic, indecipherable, and your timing would be wasted. Markets are no different. Every chart follows a repeating narrative, a silent drama governed by supply and demand, by institutional accumulation slowly gathering shares, by stealth distribution unloading them, by breakouts and breakdowns, by phases and character changes. Each phase has its own signature. Each transition precedes a significant move. Without recognizing where you are in that sequence, you risk entering or exiting the market at the worst possible moment. When the market is in its early accumulation phase, small, methodical purchases, tight spreads, muted volume, buying the dip seems safe. Yet to the untrained eye, that same behavior might be misread as a weak rally or a last gasp before decline. Enter too soon, and you may be frustrated by months of sideways action. Enter too late, and you may catch the tail end of a move just in time to watch profits vaporize. Likewise, during distribution, when institutions quietly deliver shares into demand, the public may see small rallies, slight upticks, and interpret them as bullish signals. That's how many get trapped buying into distribution just before the supply overwhelms demand and price collapses. They aren't anticipating a reversal, they are reacting to the illusion of one. Markup and markdown amplify everything. Once supply is absorbed, price surges on expanding volume and volatility tells the real story. Trust the move. But if you attempt markup-style entries during distribution or markdown-style exits during accumulation, you invite losses. Thus, timing without phase recognition is not skill, it's guessing. A guess with a confident swagger. A guess dressed in charts and indicators, pretending to be analysis. A guess built on hope instead of structure. Real timing demands discipline, the discipline to watch volume, to analyze spread, to study price behavior in context, to wait for signs of accumulation before buying, to watch for distribution before selling, to let markup and markdown unfold before riding the wave. It's not sexy. It doesn't make headlines, but it works. Because in the end, markets don't respond to predictions. Markets respond to supply and supply and demand follow cycles, repeated phases. Recognize which phase you're in. Recognize where the story stands. Only then can your timing be more than confident chance. Only then can your timing become preparation. There is a truth in market operations that eludes most traders until they've paid heavily to learn it. The market only turns after its work is done, not when you want it to. Not when the indicators flash a signal, not when the public becomes convinced a reversal is overdue. The market turns only after a long, deliberate sequence of preparation has unfolded beneath the surface, work that few are patient enough to study and even fewer are disciplined enough to wait for. Every major reversal begins silently, long before a rally explodes upward or a decline collapses downward. The groundwork is laid through a series of small but unmistakable structural changes. These changes are not dramatic. They rarely make headlines. They appear in the subtle shifts of volume, the behavior of spreads, the ease or difficulty with which price moves in either direction. These small details reveal whether the forces of supply or demand are gaining control. In early accumulation, for example, you'll see price still drifting downward, but notice how the selling pressure begins to feel different. Down moves lose their force. Volume on declines begins to dry. Rallies that used to fail suddenly show a bit more energy. No dramatic reversal has occurred because it's far too early. The buying is still quiet, selective, hidden beneath the pessimism of the public. But the groundwork is being laid. The work is being done. Only later, after this long absorption, after repeated tests of supply, after the market has proven it can withstand selling, does the true turn approach. That is when springs appear, when shakeouts occur, when the character shifts decisively. Most traders fixate on these moments, believing they are the turning points themselves. But they are not the cause of the move. They are merely confirmation that the work underneath the surface has been completed. Distribution follows the same logic. Before any significant decline, the market must complete the labor of unloading shares. This process is never rushed. It takes time to build a story that brings in buyers. It takes time to mask supply with small rallies. It takes time to distribute stock without alarming the public. Only when this campaign is complete, when the last surge of buying has been delivered into, does the decline truly begin. The drop is not random. It is not sudden. It is simply the final act of a process that finished its quiet work long before the public noticed anything was wrong. What the average trader calls a reversal is simply the visible portion of a much deeper sequence. They wait for price to turn, then react. But by the time the turn is visible, the professional has already acted or deliberately waited because they understood where they were in the cycle. The market rewards those who study the work, not those who chase the moment. The turning point is earned by understanding the preparation behind it, because once the work is done, the turn becomes inevitable. Every trader wants certainty. They want to know when to buy, when to sell, when to stand aside. But the market doesn't deal in certainties. It deals in phases, distinct periods of intention and manipulation. And each phase has its own opportunities, its own dangers, its own trades, and most importantly, its own traps. The trader who fails to recognize which phase he is operating in is not trading the market, he's trading his imagination. Accumulation is the first ambush. It never looks bullish when it begins. In fact, it often looks like despair. Price drifts lower, volume dries up, sentiment weakens, and the public grows impatient. This is precisely why accumulation rewards patience. The operations unfolding in this phase are designed to disguise strength as weakness. Buying appears timid. Down moves appear threatening. Yet beneath the surface, the strongest hands are quietly building positions. The trap here is for the trader who believes weakness will continue indefinitely, selling short into the very hands waiting to absorb his shares. The opportunity, however, is for the trader who can read the subtle shift in supply and demand and anticipate the moment the market transitions from weakness into genuine strength. Then comes phase B, the testing ground, where both sides battle for dominance. This is where most traders lose money, because they expect direction when the market offers none. It is a phase of confusion, deliberate ambiguity, false breakouts, aggressive shakeouts, and sudden rips that reverse just as quickly. The untrained trader interprets every sharp move as a trend. The prepared trader knows this is a trap-filled environment engineered to mislead. The correct action here is not to chase but to observe who is gaining control. Is demand overcoming supply, or is supply overwhelming demand? The traps in this phase punish both impatience and ego. Once markup begins, phase D and beyond, everything changes. The market moves with ease. Rallies extend without effort, pullbacks become shallow, and volume begins to confirm the path of least resistance. This is the most forgiving phase in the entire cycle. Errors are masked by upward momentum. Late entries sometimes survive. Even poor stop placement is forgiven because the underlying forces are aligned. Yet there is a trap here, too: overconfidence. Traders begin to believe the trend will last forever. They confuse momentum with invincibility, pressing trades aggressively until the market's character shifts. Finally comes distribution, the mirror image of accumulation but played upside down. It rarely looks bearish when it begins. Instead, it feels euphoric. Prices are high, volume expands, demand appears strong, and the public rushes in believing the trend has many miles left. But beneath that enthusiasm, large interests are unloading shares. They do not sell at the bottom, they sell into buying pressure at the top. The trap is obvious yet unavoidable for those who cannot identify the signs. Buying strength at the end of a campaign. Each phase carries its own message. Each phase requires its own behavior. When you know the phase, you know what to expect. When you don't, every move becomes a temptation, and every temptation becomes a trap. Perfect timing is not about prediction. It is about knowing where you are in the story. Most traders place their faith in price, but price is the last thing in the market to deliver the truth. It reacts to the forces underneath it, not the other way around. If you depend solely on price to guide your decisions, you will always be late to strength, late to weakness, and late to the turning points that professionals anticipate well before the public senses anything is shifting. The real story of the market is written in the relationship between volume and spread, the two elements that reveal the true intentions of supply and demand long before price exposes them. Volume is not just activity, it is effort. Spread is not just distance, it is result. When effort and result align, the move is genuine. When they conflict, something hidden is taking place. Professionals train their eyes to watch these two elements the way a physician watches vital signs. A small change in heartbeat, a slight alteration in breathing, these subtle variations reveal more than any dramatic movement could. Likewise, a seemingly insignificant contraction in spread during a decline or a quiet increase in volume during a sluggish rally can reveal the early stages of a major shift. In early accumulation, price may still be sliding downward. To the untrained trader, this looks like nothing but continued weakness. But volume begins to dry up on down moves, spreads narrow, and rallies show ease even with minimal effort. This is the market whispering that supply is being absorbed. Price has not turned yet, but the force generating that decline is weakening. Only those studying volume and spread will recognize that demand is quietly positioning itself for a future campaign. As accumulation matures, you'll notice a sudden firmness in the tape, down days that fail to travel far, rallies that begin to display authority, volume that expands on upward pushes and contracts on downward pushes. The market hasn't broken out, but the underlying balance of power has shifted. Those who wait for price alone will enter after the movement begins. Those who watch volume and spread already understand that the tide is turning beneath the surface. The same logic applies to distribution. While the public gets excited by higher prices, the professional watches the behavior of volume and spread with suspicion. If price rises on weakening volume, if spreads widen on down moves but narrow on up moves, if rallies require increasing effort yet produce decreasing results, these are signs that supply is quietly entering the market. A top is not formed because price reaches a high level. It is formed because supply overcomes demand, and you can see this battle unfold long before price collapses. During markup and markdown, volume and spread reveal the path of least resistance. A market in harmony sees ease of movement, rallies that expand quickly with minimal effort during markup, declines that accelerate naturally during markdown. When this ease disappears, when volume shows struggle and spreads compress, it signals the phase is weakening even if price is still trending. Price tells you what has happened. Volume and spread tell you what is happening. One of the most liberating realizations in market study is that the market's behavior is not new. Not today, not yesterday, not a century ago. The movements that confuse traders now are the same movements that confused traders generations before them. The chart patterns, the phases, the traps, the emotional imbalances, these are not inventions of the modern era. They are the byproduct of unchanging human nature, and because human nature does not evolve, the market continues to express itself in the same sequences, the same structures, the same phases that have governed trading operations for decades. It is tempting to believe that algorithms, high-frequency trading, and global access have changed the fabric of market behavior. But these tools have only increased the speed of execution and the availability of liquidity. The underlying motivations driving the people behind those orders, fear, greed, uncertainty, confidence, remain precisely the same. And where these emotions exist, the footprints of accumulation, distribution, markup, and markdown exist right beside them. Each cycle is simply a new performance of an old script. Accumulation still begins in discomfort, confusion, and pessimism. It still forms after a prolonged decline when the average participant has given up hope. Volume still dries out as selling exhausts itself. Spreads still tighten as strong hands quietly absorb whatever remains. The public still misunderstands the quiet, calling it aimless or stagnant. Then, as always, a final shakeout appears, its purpose unchanged: to remove the weak, attract the impatient, and allow the prepared to position themselves before the next campaign begins. Markup still unfolds in the same recognizable fashion. Price rises with ease. Pullbacks become shallow. Volume expands when demand pushes forward and contracts on every pause. Confidence replaces fear. The public, once uninterested, becomes fascinated again. But the structure underneath this enthusiasm has never changed. It is simply the path of least resistance, revealing itself, just as it has in every era of trading. Distribution still disguises weakness beneath the appearance of strength. It always has. Rallies become labored, requiring greater effort to achieve smaller gains. Volume becomes suspiciously heavy at peaks, not because enthusiasm is high, but because supply is quietly being delivered to those who arrive late. You can trace this behavior in charts from the early 1900s or in charts posted on social media this morning. It is the same operation, conducted with the same patience, the same deception, and the same objective. Markdown still brings panic, capitulation, and swift declines as supply overwhelms demand entirely. Traders today fear these drops just as intensely as traders feared them a century ago. The psychology is identical, the behavior is identical, and the footprints are identical. This repetition is not a limitation, it is an advantage, because once you understand that markets repeat their phases and that human behavior remains constant, every chart becomes familiar, every structure becomes recognizable, every trap becomes avoidable, and every opportunity becomes clearer than it was before. When you strip away the noise, the indicators, the headlines, and the illusion of complexity, the market becomes surprisingly simple. It moves in phases: accumulation, markup, distribution, markdown, each governed by the unchanging law of supply and demand, and each revealing its intentions to anyone disciplined enough to study them. Perfect timing is not a gift, nor is it luck. It comes from recognizing where you stand in that cycle before the public even realizes a transition is underway. Most traders chase moments. Professionals study preparation. The untrained react to price. The skilled observe volume and spread. The impatient trade every fluctuation. The informed wait for the completion of the market's work. And through this discipline, the chaos that confuses most becomes a readable narrative, one that repeats across centuries, because the emotions driving it have never changed. Every mistake you make in trading eventually leads back to one core misunderstanding: not knowing which phase you were trading inside. Once you master that, the fog lifts. You stop guessing, you stop forcing trades, you stop fighting the market's intention. Instead, you align with it, quietly, deliberately, and consistently. The secret to perfect market timing has never been prediction. It has always been recognition. Recognizing the phase, recognizing the shift, recognizing the story the market is telling beneath the surface. Do that, and what once felt like uncertainty becomes structure. What once felt chaotic becomes familiar. What once felt impossible becomes achievable.